So George, what's this stuff I hear about an asset depletion loan? I mean, I talked to somebody else and it sounds like to get one of those, I'm going to have to win the lottery first. Well, maybe not. And thanks for coming into thecreditjungle.com today. This is George Anderson.
George of the jungle, strong as he can be.
And this is actually a loan program that has been around for a long time, but it's been under different names. Now that the NonQM or the non-qualifying mortgage market has grabbed onto this, they call it asset depletion, and then everybody's competing to be able to offer this. And what it means is, just imagine like if you'd won the lottery or something like that, and let's just say you got $10 million in the bank, and your living expenses with everything else is only $100,000 a year, obviously you would have many, many years there where you could just live off of your assets, okay? So on these asset depletion loans, the non-QM banks have come up with a formula that says that if you've got so much money in the bank, okay, after you have put down, and as long as that money's been seasoned, some of them, they have different seasoning requirements. How long does the money have to have been there? Anywhere from 60 days to 6 months. The down payment's going to be anywhere from 20 to 30%. Interest rate's going to be a little bit higher. But what they're looking at there is that if you wanted to finance, let's just say a $500,000 loan, $500,000, okay, they have got, without getting into the itemized breakdown of this, it's somewhere between, you're going to need to have between 2 to 2.5 times as much money as the amount that you want to borrow available in the bank. So you're looking at here, you'd probably have to have a cool $1 million minimum in the bank, and then you could, you know, between 1 million and 1.2 million, you could get an asset depletion loan on a non-qualifying mortgage loan. Now they're still going to want to have high credit scores, okay? So is there another way to do this without having to have quite as much money in the bank? Well, the answer is yes. And fortunately, we have a lot of people that are above age 59 and a half, and some people who are buying houses are actually above age 70 and a half. And a financial planner knows why I'm saying those particular numbers. But somebody that has a retirement account, once they get past age 59 and a half, they can take that money out without paying the penalties on it. You're still going to have to pay the taxes, but you can start taking withdrawals without the early withdrawal penalty on there. And then somebody who's over 70 and a half, they have to start taking the money out of there. They just can't let it sit and grow. And I ran into a situation, I don't know, this was probably about a year ago, but there was a retired physician. And he was still somewhat involved in his medical practice, but he had business here, business there, business everywhere. And he was looking at buying a modestly priced vacation home. And he had been with another lender, and he just said, you know, I just don't have time, and I can't get with my CPA. I just can't be sitting here putting together all this tax documentation that this lender wants to be able to get for this loan. And I said, okay, well, I said, let me ask you a question. I said, you know, have you got a retirement account with a substantial amount of money in it? Well, the answer was yes. In fact, he had a few different accounts. But here's the amount that we have to have, and here's the formula for determining whether or not we can do it. The key is that you can actually do a quote-unquote asset depletion loan. You can do it as a regular conventional Fannie Mae or Freddie Mac loan, and you could do it with whatever the minimum down is. If it's a second home, 10%, primary residence, 5%, investment property, 20%. And the ratios are calculated this way. What they want to see is they want to see for a prior 2 years, okay, that you've had a history of having withdrawn the money. And, you know, fortunately, he was taking a good chunk of his living expenses out of one of these retirement accounts that he had accumulated because it was, he didn't have to pay the penalties on it. And actually, with his age, he had just barely started to have to take it anyway. And they want to see, well, how much did you take in the previous years? And in this example, let's just say that it was $8,000 a month, okay, just under 100 grand a year. So the question would be, so okay, in the prior 2 years, did you take out $96,000 per month for the prior 2 years? And if the answer is yes, well, we go 3 times 96, and what is that? 288,000. As long as you've got $288,000 still remaining in the account. So we got 2 years back, and then here we've got 3 years forward, okay? The question is $8,000 a month in income enough to qualify for a $500,000 loan? And in this case, the answer is yes. The debt to income ratios worked, and we could close the loan, and we didn't have to go with the additional down payment. We didn't have to verify a ton of money, and we got a better rate, and we got lower closing costs. So just some options on how to use an asset depletion loan. Even though Fannie Mae and Freddie Mac don't call it that, they still have the functionality to make it work. So thanks for coming into thecreditjungle.com today. This is George Anderson. Push button, get mortgage professional, and I'd love to talk with you about your situation. Have a wonderful day.
George of the jungle, strong as he can be.